Current headlines are fixated on the Middle East and the surging price of oil, framing these as the primary threats to global stability. But these stories are a distraction from a much older financial engine that, after 17 years of silence, has just awakened in Tokyo. On Wall Street, an invisible crash is already underway. Borrowing costs are exploding, and the world's leading tech stocks are facing a sudden, quiet resistance from investors. To understand why this is hitting the United States now, we have to look at the specific mechanism that has spent the last decade artificially propping up the global economy. Japan's economic shift is no longer a local issue. It puts your mortgage, your savings, and your 401k directly in the crosshairs. The core of this global illusion is a Wall Street strategy known as the yen carry trade. Hedge funds borrowed massive amounts of Japanese currency at 0% interest. They converted this free cash into dollars, aggressively buying high-yield American tech stocks and treasury bonds. This loop turned Japan into the planet's largest creditor, holding $1.2 trillion in U.S. debt. For major institutions, it functioned as an infinite money glitch, a way to guarantee returns using capital that cost them nothing to acquire. The explosive growth of the U.S. financial markets over the last 10 years relied on this foundation of free, borrowed Japanese money. This raises a fundamental question. Why would a major nation essentially give its money away for free for nearly 2 decades? The answer lies in the late 2000s, when Japan entered a severe and unrelenting demographic decline. Japan is currently losing 500,000 people every year. The birth rate has slowed so significantly that there are now 2 deaths for every single birth. This trend creates an economic vacuum. As the tax base disappears, the financial foundations required to support a modern state begin to crack. The Bank of Japan responded to this stagnation with desperation, dropping interest rates to 0 to force spending, and even buying up its own stock market just to keep the lights on. That fragile system remained in place until a global surge in crude oil and energy prices finally broke the equilibrium. Japan was trapped in a sovereign debt trap. They could keep rates at 0 and watch the yen's value collapse under import costs, or raise rates and risk the solvency of their own heavily indebted government. By finally raising rates to protect their currency from a total collapse, Japanese policymakers have effectively dismantled the primary source of the world's free capital. On Wall Street, the legendary widowmaker trade, betting that Japanese rates would finally rise, is finally paying out, ending the era of zero-interest borrowing. With interest rates climbing toward 1%, the mathematical incentive for Japan's largest banks and pension funds has flipped. Domestic bonds now offer a viable return, meaning these institutions no longer need the risk of holding American debt. They're starting to cash out. But when the world's biggest holder of $1.2 trillion in U.S. debt begins a mass sell-off, it leaves a void that no other buyer is prepared to fill. To attract new buyers and stabilize the market, the U.S. Federal Reserve is forced to respond by keeping domestic interest rates high. This creates a direct chain reaction for the average American. Mortgage rates climb, credit card costs soar, and disposable income vanishes under the weight of debt. Simultaneously, hedge funds facing exploding costs on their yen loans are being forced to sell off their most profitable tech stocks just to cover their debts. The instability in the yen is the start of a broader withdrawal. As trillions in capital return to Tokyo, the U.S. must now face its debts without its most reliable buyer, a shift that leaves the global financial system in a state of high-stakes transition.